Hi there, Kristen Cooper, your certified mortgage planning specialist, and today we're going to talk about capital gains. And so we're going to walk through this basic scenario just to kind of wrap our heads around it. It's one of those topics that can be very confusing, and a lot of people just don't know. So I wanted to walk through what this looks like so that you can understand a little bit more how this impacts you. So we're going to talk about capital gains, and what we first need to understand is what we call basis. And so if we look here and we say, okay, we purchased a home at $200,000. We're going to add into that basis, which is cost plus accusation, is going to be $5,000 for closing costs plus $45,000 for improvements that we did over the time that we had the property. We kept receipts and we could verify that those improvements were made. So that means that our actual tax basis, which is going to be our purchase plus our improvements, is going to be $250,000. So that's what we get to use as our actual purchase acquisition home improvement basis. Now we're going to say that we're selling the property. So now we're going to say we're selling the property at $500,000. We're going to take off $50,000 for the closing cost of that sale, and then we're going to take off our tax basis, which we calculated up here, which is our purchase price, closing cost improvements. So now we have our basis, which is $250,000 that we deduct from the gain. So that means we have $200,000 that's left for capital gains. So now we need to see, is there any exclusion? Well, there's a primary residence exclusion that we look at if it's our primary residence. So what that means is that we're going to take the primary residence exclusion, which states that each person can take it $250,000 every 2 years. So $250,000 per individual. If you're filing a married joint return, then for both of you together, that would be $250,000 and $250,000 is $500,000. So if this is your primary residence, you haven't sold a property in the last 2 years, your capital gains 200, then even just the individual, the exclusion would qualify, meaning you wouldn't have to pay any capital gains because your exclusion is 250,000 and your capital gains was 200, which means you still had 50,000 that you could use towards it. So no capital gains. Now let's say that this capital gains was 500,000 and it was just an individual. That means there's 250,000 after the 250,000 exclusion that you would have to pay capital gains on. Now, there's a couple other factors that we want to look at when it comes to, is this a primary residence? And that's going to be, how long have you lived in the property? So we're going to look at a 5-year timeline. So we're going to take the last 5 years and we're going to say, which years did we live in the property? You have to live in the property 2 of the 5 years in order for it to qualify as your primary residence. Now, let's say that we lived in it the first 2 years and then we moved out the last 3. Well, you lived in it 2 of the last 5 years, so it can qualify under your primary residence exclusion. Now, if it's not your primary residence, then you do have capital gains that you'd be looking at on an investment property. So this gives you a little bit more information, feel a little bit more at ease understanding capital gains. But if you have specific questions, please reach out. I'd love to give you the information that you need and help you through any questions that you have. Again, this is your certified mortgage planning specialist, Kristen Cooper. Hope you have a wonderful day.